And welcome to this session. This is Professor Farhat, in which we would look at comparative financial statement. Now, what do we mean by comparative financial statements? Comparative financial statements is when we report multiple periods at the same time. Financial statements, figures for multiple periods. You might be saying why? Well, we want the users to be able to analyze, to evaluate the company's performance over time. Therefore, we might have the current period, current year, and prior year. We might have current year, prior year, and 2 years ago. Why? Because we want to tell the users how well we are generating revenues over time. How is our cost of goods sold moving, so on and so forth. Therefore, you don't report 1 year. You can, but if you report 1 year, the users, they cannot put this into a context. Now, let's assume you're a first-year company. You only have 1 year. But once you have multiple years, you would start to prepare for multiple years. So when accountants issue report on comparative financial statement, they must refer to each period presented in the report to provide clarity on the service level performed for each period. So if you are reporting multiple period, your report will have to tell the users what type of report are we looking at in the current year? What type of report are we looking at in the prior year? Why? Because the current year could be an audit, the prior year could be a review, or the current year could be a review and the prior year could be an audit, which is two different type of assurance. Or the current year could be a compilation and the prior year could have been a review. Now also, the current year and the prior year could be the same, like both reviews, both compilations, so on and so forth. So the key is that the report should clearly show which period were compiled, reviewed, or audited. Now, if you remember when I talked about emphasis of a matter or other matter paragraph, I kept telling you we will see other matter paragraph when we look at comparative financial statements. And guess what? This is the lesson for comparative financial statements. And in this lesson, we also see how do we use the other matter paragraph in an audit report. Because I told you we'll look at that later. We'll look at that later when we talked about other matter paragraph. Guess what? Later is now, today. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great, you are looking for some additional help and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
So the first thing we have to do when an accountant issues a report on comparative financial statement, they must also update the report for the prior periods presented, as long as the report pertains both to the current and the prior periods, because you have to be updating the report. You have to make sure that the report that you're issuing covering both periods. For example, if an accountant reviews the financial statement for the current period and discovers new information about prior period that would affect the previous financial statement, well, what do we have to do? We must consider whether these developments impact the previous period. And if they do impact the previous period, let's assume you found an error in a major transaction. Guess what? You have to update the report. If so, the prior period's report should be updated to reflect those findings, that issue with that transaction. And this is to make sure that all information is accurate and consistent across all periods. Now, if both periods are compiled or reviewed, so simply put, current year is compiled, the prior year is compiled, or the current year is reviewed and the prior year is reviewed, which is going to make it a little bit easier. When all financial periods presented in a comparative are either compiled or reviewed, the accountant should update the report for the prior period and issue it together with the current period report. So simply put, or essentially, the report should reflect the most recent service level for both current and prior period. Now, if the current period's financial statements are compiled and the previous financial statements are also compiled, the accountant would issue a single updated compilation report that includes both periods. And that's perfectly fine. How about if the current year or the current period, CY or CP, is reviewed and the prior period was compiled? So simply put, we were just preparing compilation, and for one reason or another, the bank wants a report that's reviewed because they were giving us a loan for 100,000, and up to 100,000 they accept compilation. Once the loan is above 100,000, they want the financial statement to be reviewed in order to renew the loan. Simply put, they want some sort of an assurance, and the reviewed is acceptable. Or you have investors that they would only invest if you give them a reviewed financial statements. That's fine. If the current period financial statements are reviewed but the prior are compiled, the accountant must update the prior period reports. Basically, this is an upgrade of service. This updated prior period's report should be issued as the last paragraph of the current period report. So when we do this update, it should be issued as the last paragraph in the current period report. For example, in 20X5, financial statements are reviewed, but in 20X4, they were compiled. The accountant will add a paragraph at the end of the 20X5 review report to update the 2024 compilation report. So simply put, we'll add a paragraph stating that the prior were compiled. Now, how about if we went from reviewed to compiled? So the prior year, we were performing review engagement. Now we downgraded to a compiled. Now, why would we do that? Think of the opposite. Our loan balance now dropped below 100,000. And the bank at this point, once your loan balance dropped below 100,000, they accept compiled financial statements in order to have your loan renewed. And since they accept that, why pay for a review if we don't have to? So we downgrade to a compiled financial statement. So if the current year financial statements are compiled but the prior period are reviewed, the accountant has two options for the reporting. You have two options here. First option, you can add a paragraph to the current year compilation report. So you would issue the compilation report for the current year and add a paragraph that explains the responsibility for the prior period reviews. This paragraph should include the date of the original review report, and you have to tell them that no review procedures were performed for the prior period after that date of the review report. So simply put, you issue the report and you will tell them the prior period were reviewed, and since the date of the review, we did not do any additional work. That's option 1. Option 2, reissue the prior period review report. The accountant can reissue the prior period review report. This might be either combined with the current period compilation report, or you can present that review separately from the current report. If the two reports are combined, the report should make it clear that no further procedures were conducted, as I just mentioned. So for example, in X5, financial statements were compiled, and in X4, they were reviewed. The accountant may choose to add either a paragraph to the X5 compilation describing the 04 review, or reissue the whole 04 review report either separately or with the 05 report. Now, let's assume we downgraded to a prepare. So the prior year was either compiled or reviewed. Now we're going down to only preparation. Why? Again, because the lender or whoever was asking us for the financial statement, now they accept preparation. They don't want even a compiled or a review. Well, let's save some money. Let's downgrade and ask our accountant to just prepare the financial statement. Don't issue a report for a compilation, and don't do any, we're not going to engage them in a review engagement. So the current period financial statements are prepared rather than compiled or reviewed. There's no need for the accountant to reference the prior financial statement in the current period report. Because remember, the prepared, you don't have a report to issue because you don't have a report to issue. That's part of the preparation. You don't issue a report. If you remember when we talked about financial statement preparation, it's the lowest of the lowest. The lowest to a degree where we don't issue any report. Nothing. Okay? And this simplified the reporting process when a higher level of service was not performed for the current period. So that's the easiest way because no report, nothing to worry about. Additional consideration, when financial statements are presented in a columnar form, which is side by side, where one or more represent periods that have not been audited, reviewed, or compiled, it's crucial for the accountant to advise the client to make a clear indication that these unexamined statements are not subject to the same level of scrutiny. Of course, this is what we've been talking about. If you are preparing side-by-side financial statement, some of them are audited, others are not, some are reviewed, others are compiled. You have to make sure to tell the company that you have to differentiate. This prevents users from incorrectly assuming that the accountant compilation report applied to the unexamined period as well. So you just have to be clear which is which. For example, if a company present showing audited O3 and uncompiled X2, the accountant should recommend labeling 20X2 column with a clear note stating that has not been audited, reviewed, or compiled. So you have to let them know because you are seeing two periods side by side. One is audited, the other one is not. Make sure that they know this. This ensures that the users do not wrongly extend the accountant report from X3 to X2 because X2, we didn't do anything. How about no disclosure? I hope you know the answer here. Compiled financial statement. Remember, when we compile financial statements, we can omit disclosure. Why we can omit disclosure? Because the client doesn't want them. If the client doesn't want them, we don't have to go with disclosure. As long as this omission, remember, does not, the purpose of it is not to mislead the investors. Now, why would they want to omit them? Because they don't want to pay for it. They believe it's expensive. They don't need it. They want to omit them. Now, compiled financial statements that omit substantial number of disclosure required by GAAP cannot be considered comparable to financial statements that include these disclosures. So if you happen to omit, guess what? No comparability anymore because comparability is crucial for users to make informed decision. The accountant should not issue a report on comparative financial statement. That's it. You cannot compare apples to oranges. If one of them, the compiled one, omit the disclosure, that's it. You can no longer issue a compiled comparative financial statement. So in X3, financial statements include all GAAP required disclosure. X2, financial statement omit most of these disclosure. The accountant cannot issue a report on a comparative for both years. That's it. Because they are not comparable. In this case, the financial statements need to be adjusted to include the required disclosure or report should not be issued. Now you can go back and issue the disclosure. Otherwise, you cannot issue a report on this comparative financial statement. How about if we have what we call subsequently discovered information, SDI? Let's assume during the current engagement, the accountant became aware about information that would have impacted the prior year report. Well, what do we have to do? The accountant would evaluate whether any modification to the previous report are necessary. So hold on a second, we missed this transaction or there's something wrong with this transaction. We discovered this. This could include the need to remove or add modification that addresses a departure from GAAP or another applicable financial reporting framework. So if that happened, then we have to go back and either add or remove some of the modification in the report because we have departure from GAAP. So in the current engagement, okay, if the previous report must be modified, an other matter paragraph should be added. Now, this paragraph would include the date of the original report. The original report must be clearly stated to provide context of any modification or update. Changes to the prior period financial statement. Remember, we find some sort of an error. If there was changes to the prior period financial statement, we should indicate these changes in the report and the reason for the change. The accountant must explain why the prior report is being modified. This could involve correcting an error, updating a previously disclosed departure from GAAP, or addressing new development in the financial reporting framework. Whatever the reason happens to be. So if an accountant issue an X2, a review report with modification due to departure from GAAP, and during X3, they learn that the departure is no longer relevant, perhaps because the company has corrected the issue, they would need to add an other matter paragraph to the X2 report explaining the reason for the modification, and it no longer applies. This paragraph would detail the original report, the change made, and the reasons. What should you do now? Whether you are an accounting student, CPA exam candidate, especially CPA exam candidate, go to Farhat lectures, look at additional resources, MCQs. Why? If you're studying for your CPA exam, invest in yourself. Get additional questions, additional resources that's going to help you. It doesn't matter which CPA review course you are taking, Farhat can be an additional help to you. Invest in yourself. That's the best investment you could make. Good luck, study hard, and of course, stay safe.